Hey everyone, Daniel Snyder from Seeking Alpha. Thank you so much for taking the time to join us for today's event. Today we are diving into the 6 top stocks for a Fed rate cut with our very own Stephen Cress, VP of Quantitative Strategies here at Seeking Alpha. And I'll admit, we're a couple minutes late because I messed up on my side with the tech side of things, but that is a Monday for us and why we usually don't do webinars on Mondays. But thank you all for taking the time to hang out with us today. Now, before we dive into conversation and figure out these 6 top stocks, let's go ahead and get our legal disclaimer out of the way. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, or strategy, or any product or service is appropriate or suitable for you based on your investment objectives and your personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions or Stephen Cress's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results, and Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Now, with that out of the way, Steve, let's dive into the presentation today. Obviously, somebody might be here, may not know your track record here across Wall Street and then starting your own fintech company and now getting here to Seeking Alpha that you've been, elevating the product over the last few years. So would you mind just sharing a little brief history?
Not at all. Just by way of background, I've been in the world of finance for over 30 years. The bulk of my career was spent at Morgan Stanley, where I ran a prop trading desk in quantitative strategies. Fully submitted myself into it on my own. I started a hedge fund as well in quantitative strategies and a fintech company that was actually purchased by Seeking Alpha. And that's what has brought me here today. And basically taking the world of quant and trying to create a really user-friendly experience so everyday investors could use quant to their benefit and remove emotion from investing and use a data-driven approach. So that is what's brought me here today, Daniel. And thank you for arranging this. It's it's incredibly timely. Everyone's been waiting for this upcoming Fed meeting. So today, we're going to review quant a little bit and why quant. We're going to discuss the policy shifts ahead. As we know, we have a big Fed meeting coming up on the 17th. The strategy that we're employing as we are going into this meeting and our 6 top stocks for a Fed rate cut. And fingers crossed, that the Fed does cut rates because the market has made a pretty good move. I think a lot of people have baked in this rate cut. And if it were not to happen, we would probably see markets go the other way. So how do we achieve our results at Seeking Alpha? For those who are familiar, we have a number of products such as Alpha Picks and PQP, and we have a long-standing quant tracker, which has achieved pretty amazing results. It is a data-driven process. And what is quant? Quant uses data, it uses math, and it uses algorithms to identify investment opportunities and trades. We have a particular style. Not all quant strategies are the same. The strategy we employ is a GARP plus strategy, and GARP stands for growth at a reasonable price. And we have a few extra things to it. And to take a little bit of a deeper dive into what those investment characteristics are, we specifically look for companies that are collectively strong on value, growth, profitability, momentum, and EPS revisions. And when we look at these investment characteristics for stocks, it has to be stronger on a relative basis. It's not just in absolute terms. So we're not looking at a company's growth rate or value on an absolute basis. It's actually relative to other companies in the sector, and we score it. And through our powerful computer processing, we then rank those scores. And that leads us to the directional recommendations of which stocks are a strong buy, sell, or strong sell. And a little bit on the track record here. We do go back to 2010. I pulled this one out because it's a little more recent. This is our 5-year history, which goes back to 2021, and it shows that the quant strong buys, and this is taking a look at every single quant strong buy every day and rebalancing a portfolio of those strong buys compared to Wall Street strong buys and to the S&P 500, it demonstrates that we have a very strong track record. So if you were to invest just in those strong buys, you would be up 265% versus the S&P for the same period, up 85%. Now, what I like to highlight is this this isn't an investment product. The reason why we showcase this, it's not an ETF or a mutual fund, But why we want to showcase this is to demonstrate that the strategy works. So again, we're looking to identify companies that are collectively strong on those investment characteristics that I mentioned, which are value, growth, profitability, EPS revisions, and momentum. And when we identify stocks with those and we rank them, we have a very successful track record. So we want you to be able to use our system, especially Premium or Pro, and look at the quant grades and feel fairly confident at the history that we have established here. Coming on to our next slide, specifically diving into the policy shift ahead and the poised cuts and what does it mean? So right now, we're looking at the Fed's dual mandate and potential 2025 cuts. The Federal Reserve is mandated to balance both employment with an inflation target of 2%. And you can see on the right-hand side, we have a very nice chart, and it shows that inflation has remained above the Fed's target of 2%. And the reason why I want to highlight that is a lot of investors were expecting at the end of last year and the beginning of this year to have Fed rate cuts pretty quickly. And that actually did not transpire. There were no Fed rate cuts this year. And one of the core reasons why is that that target rate has been above 2%. What does the Fed use in terms of monetary policy to influence the economy? The Fed uses interest rate changes, such as during the COVID era, to hike and to balance these two goals of labor and inflation. As I mentioned at the start of 2025, expectations had pointed to 225 basis cuts with a potential third cut. And so far, none of those cuts have occurred year to date because inflation has been stronger than expected. However, there is a shift, and it's not necessarily inflation-based, it is labor-based. So those are the two components that are looking at unemployment levels, and they're looking at inflation. And what the Fed has noticed, and what we have seen in a lot of the labor data, is it's been weaker than expected. So there's been mounting evidence of weaker labor markets, and this has shifted recent policy in favor of rate cuts. And this came through loud and clear and Jackson Hole, when Fed Chair Powell acknowledged that rising unemployment could soon outweigh inflation risk. So this really tipped traders off that we really finally could see these rate cuts coming in September. And in fact, the August jobs report showed only 22,000 new payrolls, with the unemployment rate climbing to 4.3%. Now, that's no reason to panic, because 4.3%, that is still considered full employment. It's just the change and the delta that's taking place that is a little unnerving. The Bureau of Labor Statistics also revised data to show that there were 911,000 fewer jobs that were added between April 2024 and March of 2025 than previously reported. Initial job claims rose unexpectedly for September, which came out on the 6th, signaling additional labor market weakness. So this has sort of shifted policy in terms of what we've been hearing from the Fed. And on the 17th, they actually come out with what they will be doing. Having said all that, with the uncertainty with inflation and with the labor markets growing weaker, the market is still hitting all-time highs. Markets have surged, as I mentioned, even with these labor indicators coming in negative. The S&P 500 and the NASDAQ notched multiple record highs in August, while the Dow just hit a new high on September 11th. Companies have also shown robust earnings, and this has really added to market reassurance. And in fact, 81% of S&P 500 companies actually beat EPS estimates in Q2. So to a certain extent, the market is sort of projecting in that these rate cuts are going to occur. And certainly interest rate traders have changed their mind. I'm showing you here a chart, which was I actually used back on July 16th. And on July 16th, 56% of interest rate traders had expected a rate cut in September. So that was July 16th, 56% expected a cut. Bringing that forward to today, where 100% of the traders now expect a rate cut. 94% of them expect a 25 basis point cut, and 5.8% actually expect a 50 basis point cut. So it seems like the Fed has some catching up to do. Not sure if we'll get that 50 right now, but we'll find out very, very soon. It's coming up on September 17th. So what are the potential risks following a rate cut? Well, market exuberance has definitely been occurring. So the following risks could occur. One, the valuations for the equity markets are pretty stretched. They're elevated versus both a 5 and 10 year average, suggesting vulnerability to a correction if sentiment were to reverse. As I mentioned on a number of times during this webinar, markets have fully priced in a rate cut to a certain extent. Of course, with the Nasdaq and the S&P rallying in August and the Dow hitting a new high in September, there is a risk that the market has already discounted this. So if the Fed delivers less than expected or signals a more cautious stance going forward, equities could certainly face a volatile or sharp pullback, and that would be right in line with the time of year. There is a seasonality impact that we have found. Historically, late September and October have been very tricky months for the stock market. In fact, over the past 10 years, the S&P 500 has been down 60% of the time in September. And for October, it's a 50% probability. So if something were to go wrong, it seems to happen in late September or October. And I think largely if the Fed did not cut rates or change their language, we could see some weakness in the market. And of course, there's tariff uncertainty as well. That could prompt the Fed to pause after September rate cut as renewed or unpredictable tariff actions ratchet up inflation and force policymakers to reassess any further easing. All right, so that brings us, Daniel, to our barbell strategy. So instead of just going out there and saying, okay, interest rates are going to be falling, just go buy stocks, leverage up. That's actually not the approach that we're taking. We want to take a fairly safe approach as rates start to change. So our strategy is to split investments between small cap stocks and dividend stocks. And often when we refer to a barbell strategy, we are looking for companies that are fundamentally strong, that have the potential for capital appreciation. But on the other side of that barbell, we want dividend stocks where we can rely on income. And if something does go wrong, we basically get paid to wait. And those stocks typically have less downside pressure in a volatile environment because they are paying you. So what do small cap stocks offer? Well, there's a growth potential from lower interest rates. So their financing is less, which gives them more capital. Borrowing is cheaper. And historically, there's an increased risk appetite from investors for small cap stocks during periods of falling interest rates. For the dividend stocks, gives you the chance right now to lock in yields when they're higher, and it gives you stable income. And as I mentioned, those kind of stocks help your portfolio withstand any future potential volatility that could occur. Small cap companies typically benefit, as I said, from rate cuts. If you look on the right-hand side at this chart, you will see over various time periods for a 3-month period, a 6-month period, and a 12-month period. When the Fed does cut rates, small caps tend to outperform both mid cap and certainly large cap stocks, especially when you look at a 12-month period for small cap versus large cap. You can see the average return for this period was 26.6% for the small cap versus 15.6% for the large cap stocks. Mid cap stocks tend to really benefit too. They often, can be compared in a similar format to the small cap stocks. Typically, small and mid companies will have more leverage than large companies. And when you go into a declining rate environment, it really helps both of them out. And this also just shows some recent trading over the last month, as we're saying the Nasdaq and the S&P hit new highs in August and the Dow. But if you look at the market cap breakdown, you can actually see over the last 4 weeks, small cap stocks are up by about 4.88% versus large cap stocks in the very bottom, which are up just 2.36%, and mid cap stocks falling in the middle at 3.43%. So you can see investors have already sort of started that rotation. But typically, when you go into cycles of interest rate cuts, it's not usually just 1 or 2 cuts. It's a longer cycle, and that longer cycle tends to benefit the stocks. And something that's important to point out is over that longer cycle, you will have some pretty scary economic indicators that potentially could come out. It's amazing how quickly a labor market could deteriorate. And certainly when that happens, the signal will be that there's a potential that the Fed could cut rates, but sometimes investors get really nervous when they see that, or we could see some inflation data pop through that's higher than expected, which could put fear into the market. So certainly it's not going to be smooth sailing just because you have rate cut environments. Sometimes after the first rate cut, it'll take until the third cut before you start to see the market move. There could often be a reversion to the mean after a first rate cut as the market expects those further cuts. And sometimes when you get into the second cut, that's not even enough of a stimulus. So you'll have to see a longer term trend occur. So our barbell strategy for dividend stocks are more stable and less sensitive to economic slowdowns, providing defensive quality during rate cut cycles, which, as I mentioned, there could be some negative economic data points and labor data points and inflation data points, which could put a little fright into the market. So having those dividend stocks will help smooth the pain. Allocating to dividend stocks before a rate cut means investors can lock in current higher yields before those interest rates fall, which typically causes yields on other income investments to drop. And dividend stocks complement small caps by adding income and stability to the portfolio, balancing out the higher growth and potential volatility of small cap holdings during periods of monetary easing. So I really like this barbell approach to and strategy as we go into the eve of potential rate cuts here. So let's get to the stocks. We have three small cap stocks that we're going to recommend, and we're going to start off with Power Solutions International, ticker symbol PSIX. It has a market cap of 2.17 billion. It's a quant strong buy. It's in the industrial sector and it ranks number one out of a whopping 614 stocks that we rank in the industrial sector. And within its industry of heavy electrical equipment, it ranks one of 12. They specialize in design and manufacturing emission certified power systems that serve data centers. And data centers, I feel like they're the current day Pac-Man because they are taking in so much energy. They just are huge energy consumers. So anything that seems to be revolving around this space right now has done very well. And Power Solutions International is certainly on top of that. They have really benefited from it. The company has a forward EBITDA growth rate of 32%, and that's a 358% premium to the sector. It's got a whopping return on equity of 138%. It blows away just about any investment bank that I know. And the valuation framework is actually fairly attractive if you look at a PEG. On a PEG basis, it's at an 88% discount. Now, I know the stock is up a lot over the last year. It's up about 447%. But really, if anything, that should just tell you they're demolishing the rest of the sector on its strong fundamentals. And what I'm going to do, Daniel, I'm actually going to take us to our platform.
Yeah, that'd
But
be great. 'Cause I think we should also touch on people see the valuation grade there as a D plus, and they're like, "Well, isn't that a bad thing?" I think let's take a moment to explain that that just showcases that this is undervalued right now.
Well, D plus, if you're looking at it right now, that you would say is fairly valued, but we look at a lot of underlying metrics. So I'm going to click on valuation. And actually, when I'm looking at this on the conventional metrics, this looks great. So for PE on a trailing basis, it's a B minus. It's at 19 times versus the sector at 21 times. The forward PE on a GAAP basis, on a non-GAAP basis, is 28 times. That's a bit expensive versus the sector. But if we look at it on a GAAP basis for both trailing and forward, that's a great number. So it's actually better than the sector. And on a PEG basis, it's excellent. And that's what I was highlighting. PEG is one of my favorite valuation ratios because it actually combines the growth rate with the PE. So it really provides more of a solid story. Like PE alone doesn't really necessarily give you the story because it ignores the growth. But if you can bring the growth component into it and have a blended metric of PE and growth, which you get in PEG, that's why I really like it. So it actually on that valuation framework, it looks terrific because it's an 88% discount to the group. The reason for that overall D plus is we do see in terms of EV to sales and EV to EBITDA and price to sales and price to book. Those grades are what I would say is sort of in the negative domain or, what gets us into the red territory. But at a D plus, I think, that's fine for having a quant stock as a strong buy. Even an overall value grade of D is fine. There are many companies that do well when the valuation has that grade. If we look at it where it was 6 months ago, it's definitely gotten expensive. The stock has moved a lot. It's up over 400% in a year. But in terms of looking at it on a PE basis on those conventional metrics, I find this still very, very attractive. If we go into growth, this is like a straight A report card for this company. So their business is fantastic. Whether you're looking at the year-over-year revenue growth rate or the forward growth rate, it's still way higher than sector. And if we get to the bottom line and we're looking at the EPS growth rate, year over year was 146%, not quite that high for the upcoming forward looking estimates. And the forward looking estimates, our model is historical looking and forward looking. For the forward looking estimates, we take the consensus of Wall Street analysts. So if we're looking at revenue growth or EBITDA growth or EPS growth, we take the consensus of Wall Street analysts, and the consensus of Wall Street analysts is having this company grow at 51% versus the sector at 8%. And that's huge. So really like straight A's there. And in terms of profitability, it looks really nice as well. That overall profitability grade is an A. The EBIT and EBITDA margins come in with B grades. So their profitability versus the sector it's pretty high. If you look at the EBIT margin on a trailing basis, the absolute data point is 16%. The sector's at 10%. So it puts it at a premium to the sector of 60%, which is exactly what you want for an EBIT margin. And then, like, the real kicker here is the return on equity. It is just huge at
Massive.
138% compared to the sector at 12%. So really liking this stock. I'm going to take us back to our
Steve, I want to
presentation.
mention real quick as well. If you look at the growth and profitability grades there, 3 months ago, I mean, growth was at a C plus and profitability was a B minus, and now both of those are just a nice strong A. I mean, that is improvement over the last 3 months.
Yeah, it feels like in the last 3 months, and even going back over the last year, but certainly the last 3 months, it's like they're printing money. So, and if anyone is familiar with the incredible demand for energy that comes from data center, they can understand why this stock is doing so well. So
Right
I'm going to
place,
take us
right time.
yeah, I'm going to take us back to our platform and enlarge the deck so that for those who are on their phone could see it. Our second stock is not does not revolve around the data centers. It is Heritage Insurance Holdings, ticker symbol HRTG. This is actually a smaller property and casualty company. The market cap on this is 721 million. However, even though it's small within its sector, it ranks 10 out of 686 stocks within financials. And within property and casualty, it ranks 1 out of 52. And what I like here is the forward P on this company is only 6 times. It's dirt cheap. It's about a 51% discount to the sector. The EPS diluted growth rate for the company is 33%. So it's got a forward P of 6 times and a growth rate of 33%. That growth rate is a 228% premium to the sector. This company also has a really big ROE for finance. It's got an ROE of 33% versus the sector at 11%. And analysts really like this company. In the last 90 days, 3 analysts have taken their earnings estimates up for the stock. Not one analyst has taken it down. So some people might be saying, insurance during a period where the Fed could be lowering rates. So I could understand a little skepticism there. But what we have actually found historically is typically in a lower rate environment, a property and casualty company could earn less income on their portfolio. However, it typically really gets offset by the increased economic activity and the growth that occurs because of that. So they actually end up gaining more business in property and casualty when interest rates come down, despite their overall portfolio earning less money. So it should benefit them. And certainly the stock has done fairly well in terms of the valuation. If you look at the right-hand side for the factor card, you can see it's an A relative to the rest of the sector, pretty much in line where it was 6 months ago. I would say the growth is even better than it was 6 months ago. If you look at that factor grade, and remember, these are all sector relative, you can see the growth is strong, A minus versus the sector, but on an absolute basis, if you look at it 6 months ago, it was actually a B minus for the growth grade. So the company has grown nicely over the last 6 months. The momentum has been very strong, and analyst revisions have been very positive. Our number 3 stock is Wilden Group, ticker symbol WLDN. Market cap on this is 1.48 billion. This is a quant strong buy. And in the industrial sector, ranks number 7 out of 614. Within research and consulting services, it ranks 1 out of 38. So this company provides engineering and consulting services that are focused on energy efficiency and infrastructure modernization. which is exactly what our utility companies need right now. And a lot of data centers need that as well. So just a super huge focus with the advent of AI and the incredible demand that it puts on data centers and the demand that that puts on energy needs. So whether it's a consulting company or a vendor for data services that revolves around energy efficiency or utility companies, most of them have been doing really, really well over the last few years, and it doesn't seem to be slowing down. This company has a forward EPS growth rate of 32%, and that's a 293% premium to the sector. The return on equity is 15%. That's 20% above the sector. And on a PEG basis, it's 0.5 times, which puts it at a 60% discount. So that valuation framework, very attractive when you look at it on a PEG basis. And the company over the last year, it's had a return of 171%. Again, do not let that bother you because the growth now is just as strong as it was 6 months ago. And analysts continue to revise their estimates up, which is really positive. So now that brings us to our three dividend stocks, the other part of the barbell strategy. We have three small cap companies that have very strong fundamentals where the financials look great, should benefit as small caps perform well in an environment where interest rates are going lower. But the three dividend stocks give us a chance to lock in higher yields before rates go down. First recommendation is a REIT known as Alexander and Baldwin, ticker symbol ALEX. Company has a market cap of 1.34 billion. It is a quant strong buy. And within the real estate sector, it ranks 5 out of 176 REITs. Within its industry, it's known as a diversified REIT. It ranks 1 out of 13, and it's got a really nice yield at 4.89%. So this company does have a niche focus, even though it's a diversified REIT. Their focus is within the Hawaiian real estate market, which seems to perpetually do well. The AFFO growth rate for the company is 10%. That is huge compared to the sector. It's at a 299% premium to the sector. The 10-year dividend growth rate for this company is 17%. That's on a CAGR basis, and that's a 630% premium to the sector. We have a specific metric that we use. When we look at REITs, there's a lot of metrics that are very centric to REITs, and our quant system uses these specific metrics. One of them is known as FFO to gross margin. It's a ratio, and it's a 92%. But on a 92% level of that gross margin, it's a 40% premium to the sector. And the interest rate coverage for them is 3.6 times. So that is a 97% premium to the sector for interest rate coverage. So certainly indicating that that dividend is safe, but the growth rate and the FFO to gross margins indicating that the company has a growth rate but profitable at the same time. Our next stock, number 5, is GCM Grosvenor, ticker symbol GCMG. This has a market cap of 2.5 billion. It's a quant strong buy. This is within the financial sector. So remember, I'm telling you here that it ranks 38 out of 686 stocks. But when we look at those 686 stocks, those are all market caps. And a lot of times the financials tend to be dominated by larger market cap stocks. So the fact that this comes in 38 is pretty good. Specifically, though, within the asset management and custody banking segment, where you have a lot of large players as well, this actually ranks 3 out of 96. So despite being smaller compared to big custody banks and asset managers such as Northern Trust, this looks really good. Nice yield at 3.42%. They are a global alternative asset manager, and they focus on private equity and real estate and commodities. Company has an operating cash flow rate of 63%. That is huge compared to the sector, a 427% premium. The return on capital is 15%. That's 115% premium to the sector. And analysts really like this company as well. In the last 90 days, 5 analysts have revised their earnings estimates up and 0 have revised it down. It has an 8.3% forward dividend per share growth rate, which is very high as well. If you look at the cards that we set up on the far right, looking at the factor cards, you can see the valuation is attractive with a B. And it's actually more attractive than it was 6 months ago when it was a B minus. Growth comes in as a B, profitability comes in as a B, and the EPS revision grade is actually up slightly from where it was 6 months ago at a B plus versus a B minus. The dividend safety grade comes in at C plus, and dividend growth grade comes in as C, as you can see in these cards here. So we feel very comfortable with that as well. And Daniel, our last stock, which is one we haven't really recommended in a while, is Merck. Merck is a huge company. It's got a market cap of 206 billion. This is in the pharmaceutical industry within healthcare. It ranks 66 out of 962, and it's got a forward yield of 3.91%. This is actually a quant buy, not a strong buy, but very comfortable with the yield that it's providing, very comfortable with the valuation and the growth rate, and very comfortable with the dividend safety grade coming in as B, and a dividend growth grade of A plus, which to me, having a strong dividend growth rate is almost more attractive than having a higher dividend safety grade. So Merck notched over 15 billion in worldwide sales while exceeding earnings expectations in the last quarter by 10 cents. It has a 2.9% 4-year average yield. And that 4-year average yield is at a 111% premium to the sector. The EPS diluted growth rate is huge at 85%. Absolutely huge for a pharmaceutical company. That puts it at a 900% premium to the sector. The EBITDA margin is 45% and that puts it at a 338% premium to the sector. Tremendous cash from operations at 18.5 billion. And one metric I like to look at is actually cash per share. Cash per share is at $3.20, which is a 149% premium to the sector. So Daniel, you'll hear me repeatedly refer to the sector, the sector, the sector. And really so much of investing is taking a look at a company, specifically the data points and the metrics for that company compared to the sector. And really the mother's milk of investing is looking at growth and valuation for a company, but you have to look at it versus the sector and put it on that relative basis to get a good understanding if that's a good investment or a poor investment. So Daniel, that brings us to the end. We have Power Solutions International, Wilden, Heritage, Alex and Baldwin, GCMG, and Merck. This sort of shows you where the grades are. Pretty much green across the board with the exception of the two valuation grades for PSIX and Wilden, but we're absolutely comfortable with D plus valuation grades. The rest of the report card looking really, really strong. And then when you look at the forward yield for the last three, coming in at 4.89%, 3.42%, and 3.91%, that yield is far, far higher than the yield on the S&P 500. And it's even higher than the Vanguard Income and Growth Fund. So significantly higher than that. So really two nice offsets with our barbell strategy, getting companies that offer that yield, but also offering small cap companies with really strong fundamentals. Dan, any questions before I go to the next slide at all?
No, we do have questions, but I was hoping we could get through this.
We'll do that at the end. All right.
Yeah, go ahead and get the next slide because I want people to follow you here on Seeking Alpha, your author profile.
Go ahead. You do the slide. You take it.
I mean, yeah, I will. I mean, obviously, if you have joined our webinars in the past, or if this is your first one, this is where kind of the meat of all this video content really comes from. It's Stephen Cress's author profile. He's constantly putting out research for everyone. We're talking about various stock picks for different ideas. So it doesn't matter what your investing or trading strategy is. There's a lot of great quant focused ideas, and there's more content there than we can do within webinars because they just crank it out so quickly. So everybody go over to Stephen Cress's author profile. I put the link in the chat. We'll link it here below the video if you're watching the replay as well. Give him a follow so that whenever a new article goes out, you'll receive that directly in your inbox. Now, Steve, I was hoping you could take this next slide because we need to talk about these two things because there was actually a lot of questions about PSIX was actually in the ProQuant portfolio at one time. And we'll talk about that here in a second. But can you walk us through, like I said, there's so many different investing strategies, trading strategies, and your team has built out these two incredible products. Both have incredible returns, but they're made for different types of investors and traders. Can you break us down these two things?
Yeah, absolutely, Daniel. You know, really, as you mentioned, I put out a lot of articles, and we're going to have an article out tomorrow talking about this barbell strategy and the stocks that I just discussed today. So you really sort of have an early preview on the article that's coming out. But the reason why I mentioned that is after having produced a number of articles, there were a lot of our subscribers at Seeking Alpha that wanted an easier way to identify the stocks that come out of the quant system. So about 3 years ago, we developed a product called Alpha Picks, and I'm going to tell you about that. And Alpha Picks provides two of our favorite quant ideas a month. And then after we developed Alpha Picks, a lot of subscribers said that they wanted a higher frequency of ideas. So just this last June, we developed a new product, which is called the ProQuant portfolio. So for those of you who are not familiar with these products, I'm going to tell you a little bit about them. But really, the common thread is they select our favorite quant strong buy stocks, which, as I showed you before, have a very strong track record. When I showed you that track record earlier, I said that's not really an investable product because that on any given day could be 350 strong buys to 400 strong buys. But what we have here are products that are make it easier for you to invest. So on the left-hand side, you see the ProQuant portfolio. As I mentioned, we just started that in June, and it is already off to a smashing start. The return for the ProQuant portfolio since June is up 40% versus the S&P 500 on an equal weighted basis, up only 6.83%. And the reason why we look at the S&P 500 on an equal weighted basis is this portfolio is equal weighted. So what is PQP? It is 30 stocks in a portfolio that are quant strong buys. And every week on Monday, we announce a rebalancing. So some of the stocks may come out, some of the new stocks will come in. It's a really nice process. It's very consistent. So every Monday, people could take a look at the portfolio and find some of our new favorite stocks. It's an actively managed portfolio. Again, all data driven, and it delivers our high conviction ideas. There's a separate platform on Pro, so it's really easy to track. Plus, we also send emails out as well every Monday, which tells you which stocks you want to buy, which ones you want to sell. On average, on a weekly basis, it's about 2 to 3 trades. Some weeks there's no trades. Some weeks there could be 5 or 6 trades. But typically we find on average it's about 2 to 3 trades with stocks coming in and out of the portfolio. And as you can see from the track record, we started it May 30th. It's currently September 15th. That's not that long. And the portfolio is already up 40%. For investors who do not want that amount of activity in terms of trading and just want a couple ideas a month, we have Alpha Picks. Now, Alpha Picks came out over 3 years ago, and it's had terrific performance. Just year to date alone, Alpha Picks is up 31% versus the S&P, up 12%. Over the last year, you can see that the Alpha Picks product is up 54% versus the S&P up 17.5%. So it's really, really crushed the S&P 500. So as I said earlier, this tool is designed just to provide our two favorite quant strong buys every month on the trading day closest to the 1st of the month and the 15th of the month, which is today. We will actually be revealing our Alpha Pick stock, and we may have actually done that already.
Yep.
So it doesn't have the same high frequency that you have with PQP, but for many investors, 2 picks a month is good. And this is really designed for long-term investors that seek capital appreciation. In fact, if a stock is in Alpha Picks and the rating drops from a strong buy or buy to a hold, we'll actually keep it in the portfolio as a hold for 180 days. With the ProQuant portfolio, it's a much higher frequency of removing the holds, but hold means hold. It doesn't mean sell. And we often find when we let the winners run in Alpha Picks, it really pays off. So Daniel, I hope that provided a good description. Do you have any questions on the back of that?
Yeah, I was just going to say quick summary, right? Just to boil things down quickly. Alpha Picks, more of a longer term strategy there. ProQuant portfolio, more high, rapid, weekly, kind of in and out. So if you're looking for either of those, I would tailor you to that. But to loop it back to all the questions earlier when you were talking about PSIX, which at one point in time was in the ProQuant portfolio, these are both systematic approaches. So when the system sells, take it out, we take it out. When the system says this is your next pick, this is the next pick, It's because we trust the computer over the human bias. That's found everywhere on the internet. Like if you just have to throw a rock, you'll probably run into some human bias. But so Alpha Picks, I've added both of the links there in the chat for you. They're below this video as well. If you want to learn more about Alpha Picks, again, as you mentioned, the pick just recently came out. They're going to be doing a webinar today at 4 p.m. Eastern about the newest pick. And that I also want to mention, you're on top of your analysis and your community engagement within both of these products. I mean, the team is always there making sure that everybody has everything they need. We're doing this for you. I hope you all know that. Transparency is key here at Seeking Alpha. So the systems are pretty transparent as much as we can be, except for the proprietary stuff. But Steve and the team over on the Quant team, I mean, Alpha Picks, PQP, can't recommend them enough. But with that out of the way, let's get back to the 6 picks, because that's what the people are here
All right,
for.
let's do it.
For 2,000 of you. There was a question here. Obviously, we give pick ideas like this, and PSIX being here, just top of mind. People are wondering, how long do I hold these picks? That seems to always be the question. How long do I hold the picks, Steve? What would you recommend?
All right, let's go to the platform. So we're going to go to the summary page. And really, the beauty of this is it instantly can tell you what to do. Now, people benefit by being able to instantly see what to do. But believe me, we every single day are running millions and millions of calculations on millions and millions of data points to derive what you see instantly. So our subscribers are a huge benefactor of a very, very complex quantitative system that makes it user-friendly for you. So when do you get rid of it? You'll see the quant strong buy here. When that quant strong buy goes to a sell or a strong sell, that's when you know to get rid of it. Sometimes and often you will see stocks go from a strong buy to a hold. Hold means hold. It does not mean sell. And even with our Alpha Picks portfolio, we will keep stocks in there for 180 days as a hold before we remove it. Typically, after 180 days, we're like, okay, let's make room for other stocks. Been there long enough as a hold. But often many of those hold stocks can continue to run. So that's why we say hold means hold. When you want to sell it, it's when that rating changes.
All right. So going back real quick, there were some good questions that just came in about Alpha Picks and ProQuant portfolio. Do you need to mention Alpha Picks? It's $4.99 for just the first year if you want to check that out. And also ProQuant portfolio, I believe, has a promotion going on where it's $99 for the first month. People were asking about the cost there for those. So Steve, a question came in about, I believe it was Merck. We were talking about Merck and how it is the healthcare pharmaceuticals kind of area. There's a lot of questions about what's coming down the line that the administration's kind of hinted at a little bit. Does that worry you at all of what they're trying to do with maybe it's the tariffs in the pharmaceuticals or the shakeup with the, RFK and CDC?
Yeah,
and all?
Dale, great question. So I'm going to take us right to the growth card. If you recall, during the presentation, I mentioned our quant system. It's both historical looking and forward looking at the same time. When we look at the revenue forward growth rates and when we look at the EPS forward growth rates, this is using Wall Street analyst consensus. So those analysts are the ones who are doing work and paying attention to those potential policy changes, regulatory changes. So they will put that into their numbers. And hence we are taking the consensus of those numbers. So I feel fairly comfortable, unless there's something that's a sudden event that analysts have not captured and have not modeled into their portfolios. It might not be there. But chances are with anything like this, a lot of analysts have started to model that into their numbers. Maybe they've gotten a little conservative. So I am still loving Merck. When I look at the forward growth rate of 85%, that is huge. So I love that it's hard to find a pharmaceutical company because there's so many biotech companies and biomed companies that can influence the overall healthcare sector. So when I look at pharmaceuticals, sometimes the pharmaceuticals, especially historically, people have viewed those companies as sort of a bastion of stability. Pharma stocks typically have paid out dividends in the past. But when you add sort of the bio aspect to it, it makes it pretty volatile. So I do really like the fact that Merck comes within the pharma industry. It's sort of one of the old, true and tried companies. And when you look at that dividend safety card, I like the fact that it's got that B there. So I still fairly safe for that at a B.
All right. Now, Steve, I know we can't give direct recommendations on how people should allocate capital across these 6 stock picks, but Javier here is wondering, what are your thoughts about options when we put out top stock picks like this? I mean, is options, any thoughts on that?
I think options are very, very intricate, and you have to be very familiar with options. So, and in fact, many investors have to be approved to trade options by their brokerage firm as well. So, unfortunately, we don't know what your risk tolerance is, and our quant system is not assessing the option metrics at this time. So I really would not be able to give guidance along options. However, what I would say is, if we like a company that is fundamentally strong and it's got a strong buy, certainly that could weigh in your decision to do options. I would not buy calls on a quant company that was a strong buy. So, I mean, I would not buy puts on a company that has a quant strong buy. So I certainly would, avoid having that kind of strategy. But it's really up to the individual and the time frame that they have.
All right. We got a question here around, as I mentioned earlier, a very transparent approach we take here at Seeking Alpha. So, outside of any ETFs you might personally hold, it says, does Steven have any personal positions in any of these stocks?
No, I typically don't hold positions, and sometimes I get a lot of criticism in that. Usually I'll buy stocks in the beginning of the year when we have our top 10, but at any given day, we have about 350 to 400 strong buys. So there's no way that I can hold all those strong buys in my portfolio. And I also try to avoid owning a stock that I'm recommending. Often it can come across as like front running. So our audience is pretty mixed on that. Many of our subscribers want me to have a stake in the companies that I'm recommending. Others could, understand the ethics behind not wanting to be front running stocks that I'm publishing on. It's about 50-50. But usually in the beginning of the year after I publish my top 10, I'll be buying those stocks.
There you go. I know I'm looking forward to that as well. We've been crushing it the last, what has it been, 3, 4 years now? We've been doing that top 10 stocks event.
Yeah, and it's absolutely been crushing it. Yeah.
We're gonna be great. All right, diving in here. So there's a question here. Do you have any price targets for any of these picks? Actually, any of the picks we put out, because I've seen this question on other webinars. Do we put out price targets on these stocks?
We do not. As an investment research analyst, I got to tell you, I actually do not believe in price targets. I know they're widely used by brokerage firms, and I feel like that's really sort of a gimmick just to entice people. If they see a stock with a price target of $200 and the stock is $10, you kind of think, oh, this has huge upside potential. But really, when we look at stocks, we have to look at the valuation framework and the growth framework and the profitability framework relative to other stocks in the sector. And, often you'll find on Wall Street, when a company hits a price target, the analyst just simply like raises their price target after it hits it. So, those are not the metrics we're looking for. We're looking for data points that revolve around growth and valuation and profitability and how it compares to the other companies. And that determines whether it's a strong buy. So typically, if a stock is a strong buy, it's mispriced and it should be appreciating versus the sector. So to answer the question, we do not use price targets, not a believer in it. There's many other metrics that are very important for you to assess on a sector relative basis.
And as Jim Simon says, follow the model. Don't change
Yes.
it. All right. We got a great question here from Fabiano. He says, I am an AlphaPix subscriber. Thank you for being an AlphaPix subscriber and being here. Do ProQuant and AlphaPix stocks overlap in their recommendations, or do they generally provide distinct ideas?
Sometimes they do overlap. You have to remember with both systems, we're trying to identify our favorite quant strong buy stocks, but the criteria and parameters are different for both after that initial quant level. So as a result of that, by example, with AlphaPix, we won't recommend stocks that have a market cap under $500 million. With ProQuant portfolio, we will. With AlphaPix, it pretty much is US equities and ADRs that are only primary listed in the US. With a ProQuant portfolio, it's much more diversified on a global basis and ADRs that are not primary listed. So just between eliminating that market cap restriction for ProQuant and having a much larger investable group of stocks, it does make ProQuant different. However, occasionally there is crossover on the stocks, but not a lot.
All right. We had a great question here. I know we're getting close to the top of the hour. We're going to squeeze as many as we can in. What about gold and silver during rate cut cycles?
Well, It's looking pretty good. If you just look at the last year and especially like the last month, gold and silver stocks have been doing very well. You will find it might seem counterintuitive, but because rates are coming down as a result of something not going well with the economy, gold and silver will tend to do well. So they're safe haven commodities. Investors rotate into those commodities when initially you find rates are coming down, because rates coming down are a warning signal that something's not working. What's not working right now is the labor market and the change that we're seeing in that. And of course, as I said, there's no reason to panic with unemployment at 4.3%. That's still full employment, but we're seeing a change and it is worsening. So people will rotate to gold and silver when you have that type of economic change occur.
So correct me if I'm wrong here, because you keep mentioning the 4% unemployment. Is it high fours? Is it fives? When would most people start to take notice and start to have a little bit of fear there?
For me, historically, when it hits like starts going north of 5.3%, uh, and especially if it's changed, it's had a dramatic and a quick change. So if you've gone from like 4% to 4.3 to 4.5 to 4.7, historically, I feel like that 5.3% level, and that's not far off of full employment, but investors do tend to start getting nervous then, especially if it's accompanied by inflation that's a bit sticky or higher than expected.
Yeah. All right.
That's
Let's
why you'll
squeeze
be
this.
thankful if that does happen. You'll own the dividend stocks as well.
Yeah, no kidding. Let's just squeeze this one in. Tim wants us to revisit the sector comparison. Why is sector comparison so important?
So let's go back to that sector chart. All right. So we'll pull up we'll go to Merck by example. We'll go to the summary page. So why is it? Yeah. So many, many years ago, it was kind of hard to compare stocks on a sector basis. You didn't have the data that was available today. You didn't have the power of computer processing to instantly summarize what the average level were on specific data metrics. So people would typically say, okay, I'm going to look at a company's PE and I'm going to look at a growth rate. And based on that, I'm going to make an investment decision. However, it's really a faulty way to do it because you're just looking at the absolute data. If you want to know if a company is strong or weak compared to its sector, you have to measure it on a sector relative basis, let alone like for all stocks in general. And actually, we do that. So if you take a look over here, we do show where a stock ranks versus all stocks. So in the case of Merck, it ranks 475 out of 4,200 stocks. Um, if we take a let's look at something that really is well known. Let's look at Amazon. And if I get the ticker symbol right there. So that's actually a hold right now. They do have very strong growth. The valuation is at a D. Company comes in at 714 out of 4,297. Within the sector, it ranks 80 out of 480. Within the industry, it ranks 6 out of 25. So actually, based on the metrics, that's not a strong buy. But let's put in something like PSIX. All right, so this is a quant strong buy, and you can see out of all the stocks that we look at, so this is most investable stocks, irregardless of sector, PSIX ranks number 6 out of 4,200, and within its sector and its industry, it ranks 1. So you can begin to see the importance of looking at a company on a sector relative basis. You don't want to buy a stock just because its absolute data is good. You want to buy a company because it's better than other companies. And that's exactly why we look at a stock on a sector relative basis. And the beauty of our premium or pro platform is you get an instant characterization of where a company compares versus its sector. And it's kind of interesting. Somebody, Daniel, actually asked me, what's the difference between Seeking Alpha's platform and a platform like Reuters or Bloomberg? And honestly, we provide a service that you don't even get. And that's basically giving you an instant characterization of where companies compare versus its peer group. On those platforms, you get the absolute data, much as what we have. So if you go to the financials page, for example, you'll have this on Seeking Alpha, and this is what you'll get on your Bloomberg or your Reuters. But what you don't get on those platforms are these factor grades that give you the instant characterization of where a company compares versus the sector. And that's what makes it so valuable, because it helps you make that investment decision.
All right. Before we get to the last question here and wrap things up today, I do want to mention, if you're interested in joining Pro, that if you do reach out to our customer support team, subscriptions at seekingalpha.com, and you're already a premium subscriber, they will help you roll up the leftover cost, if you will, of your subscription into the next level. That is a nice thing that they've been doing lately for everybody. And thank you for watching the replay, if you are. So, Steve, last question here before we jump off today. We did have the real estate name. I believe it was Alex, Alex.
Yep. So Alexander Baldwin. Yep.
Yes, exactly. Included in today's top 6 stock picks. But there was a question about real estate overall, right? There's lots of different types of real estate, commercial, whether you're looking at Las Vegas gaming, whatever it might be, data centers, industrials, the whole thing. What are the thoughts about the interest rate cut coming and how it might affect real estate as an overall sector and not something so niche?
Yeah, it's, it can have a mixed impact. Similar to what I mentioned on Heritage, a lot of times, uh, when interest rates go lower, this would be based on collections. Sometimes the income levels that these companies collect could be lower. When you go into an initial period of interest rate cuts, there's a fear that companies that are leasing or renting may have to pull back because they're running into economic issues. However, for the companies themselves that survive and lease, a lower interest rate environment will benefit them and usually gives them more cash on hand. So it can be a little bit unpredictable in the REIT sector, where you want to look at. And the beauty of this is, we do break it down to the industry. There are a lot of different types of REITs. Some could be data centers, some could be retailers, some could be cannabis REITs. So there's all different kinds of REITs out there. We break down the industry for you. And our preference during this period would be to be in diversified REITs. And you can see in the last month, it's about flat. There was a period where it went up, a period where it came off a little bit. So people are trying to determine, what looks good. But certainly within the REIT sector, there's going to be some segments that do well, some that do poorly. And if some can just hold their own and you get that yield of 4.89%, you're looking good.
All right, Steve, let's go ahead and leave it there. Everyone, thank you so much for taking the time to hang out with us for this hour. Hopefully you find some great value in these 6 stock picks here today. PSIX, WLDN, HRTG, ALEX, GCMG, and MRK. I've already created a Seeking Alpha portfolio under my account. I hope you do the same so you can at least track them. Keep them front of mind as we enter into a wild week here, Super Bowl week for FOMC on Wednesday afternoon. Steve, thank you so much for the time. Everyone, take care, and we'll see you again here in the next webinar. See you soon.